Welcome to On the Investor's Mind. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with your portfolio construction and asset allocation. So in this episode, I want to discuss a really important topic for a lot of our APAC clients, which is sustainable investing. And ESG, frankly, has been taking center stage in a lot of the policy decisions around the world in the recent past. So I'm delighted to be joined by Tomomi Shimada, who is our Head of Sustainable Investing Client Solutions for APAC on this podcast, and really share with us some of the most recent developments when it comes to ESG and how that applies to APAC investors. So Tomomi, welcome to this podcast.
Thank you for having me, Tai.
So let's set the scene. Is ESG still relevant and important? We've had a lot of news recently about policy changes in the US, in Europe, in many parts of the world. And as a result of that, why is that relevant and why should we still think about ESG?
Sure. Thank you for the question. I guess I'll start off by thinking about who we are. And as active investors, our primary goal is to deliver financial returns to our clients. So to do this effectively, we have to consider all the factors that could impact the value of our investments. So in a way, ESG integration is a natural extension of this process. For instance, if a company faces governance issues that could hinder shareholder returns or risk due to inadequate climate strategies, we need to consider these factors into our analysis. So to us, ESG is really about making informed investment decisions, and that's why we believe it remains crucial at this time. There are also clients who want to go beyond purely considering those financially material ESG factors and prefer to incorporate sustainable objectives in their investment too. So our job is really to make sure we provide solutions to those clients as well.
Great. So from that angle, I think ESG is still highly relevant, not just from doing a good thing, but really potentially generating financial returns. So why do some clients want to incorporate sustainable objectives into their portfolio? What's the motivation behind that?
Yeah, we believe this trend really reflects a broader shift in our economy. So corporate behaviors and government policies and consumer preferences continues to evolve, and investors increasingly want to align their portfolios with companies that are navigating certain changes that we see from both risk management and opportunity perspective well. To give you examples of these changes that I just mentioned, if you think about food, and especially food security, our ability to produce food and feed people, lots of scientific analysis has shown that higher temperature can stress crops and reduce yields. For example, there is a study that found for every degree of Celsius increase in the temperature, wheat yields could decline by 6%. And similar situation goes for other crops such as rice and corn. And there are other factors such as increase in pests and disease that further lead to yield reduction. And what's scary is that higher CO2 levels in the air can actually reduce nutrition too. So studies have shown that higher CO2 concentration in the air can potentially lower the protein, zinc, and iron in stable crops. So there's less food or less nutrition provided. And on the other hand, our population is expected to be around 10 billion by 2050. So there is a severe mismatch of supply and demand in food. So we know that rice production must increase by an additional 25% to meet the global population demand. You can now look at this from risk perspective, but it could also be areas of future growth and potentially opportunity if, let's say, a food and beverages company is able to produce food products or services that contributes to solving this type of issues through innovative technologies such as effective alternative food products or precision agriculture to increase the crop yield.
Great. So I think, again, I think climate change and change in temperature, you've had an excellent example of farming and food production, but I think that's also been highlighted as one of our key risks for investing around the world. It could be droughts or floods that have a direct impact on production and manufacturing in many economic activities. So let's continue with the why. And let's talk about why now. Now, we're seeing selected governments seems to be rethinking their policies and or rethinking how they balance between growth and climate commitments. There's a recent examples where the UK is talking about a third runway for Heathrow Airport. While there could be considerations on carbon emission, but at the same time, they do want to boost the capacity for the airport and facilitate growth. That's one example. So how do you see the same for financial institutions around the world?
Well, when it comes to the private sector, including financial institutions, I don't think growth and climate commitments are mutually exclusive. So the real questions that I think is important is how they can coexist. And that's really why we're focusing on areas where climate innovation is expected or where risk management is essential. So while large-scale commitments around climate are less emphasized, and we have seen that in the industry, individual business actions around climate continues to be crucial. You're right that there's a lot of uncertainty remaining in the public sector and what governments will do. We do not know how the full picture would look like around clean technology in the US. But we saw President Trump in the US issuing 5 presidential actions on energy and environment, which is essentially pausing the IRA, withdrawing from Paris Agreement, and directing more production of oil and gas. So we do expect headwinds, especially around in the US, around the development of certain technologies that have not gone to legislation yet, like the green hydrogen. Now, having said that, there are some pockets of technologies, even in the US, where we expect the companies needing to or wanting to remain competitive, such as the carbon capture technologies. And they do not want to be completely out of the race when it comes to innovation on these carbon capture technologies. So these may continue to have some kind of support. Some companies, including major oil and gas companies in the US, actually have voiced that the US should not be pulling out of Paris Accord, and these companies are expected to stick to their own individual decarbonization target, regardless of what happens at the country level commitment. And this is really because those companies are already very heavily invested into energy transition and technologies such as carbon capture. And also they do see the long-term necessity to do so. And that's where the global demand is still headed to. The last thing I would mention is, despite all that's happening, I do think that global structural need to move to clean energy and momentum of ESG regulations outside of the US remains intact. So in the context of sustainable investing, I believe that we just need to look more carefully where the opportunity and risks are coming from.
So that's very helpful to set the scene, because obviously, yes, governments around the world could always change their policies depending on what voters are voting for. But I think it's undeniable that the world is getting warmer, and there will be economic and social impact on a lot of our production activities. And as a result, there are opportunities emerging from that. So we've discussed the why, and let's move on to the how. Undeniably, the hottest theme right now in investing remains to be artificial intelligence, AI. And we see that it's been transforming how we live, work, and play, not just right now, but really in the next 3, 5, even 10 years. So it's also set to transform global progress on sustainability. How should investors consider the environment and social risks and benefits of AI when making investment decisions?
I think an important point to remember is that AI can be a powerful tool or a potential risk depending on how it's used. So for example, AI consumes significant amount of energy through data centers, and the International Energy Agency has highlighted that energy use in data centers and data transmission networks could grow at a compound annual growth rate of around 23%. And if the source of energy is not clean energy, this becomes an issue from climate mitigation perspective, obviously. At the same time, AI can also be used as solutions around energy efficiency through items such as smart meters, or even could be used for something like traffic management, which helps to reduce the usage of fuel. And latest developments I'm sure that everyone is interested around DeepSeek, for example, which is claiming to be much more energy efficient. Sounds promising, but there is still an ongoing debate on their technology around how much energy it can actually save. So some say that the energy that they save on the training process is actually offset by its more intensive techniques for answering questions. So we are yet to see what the full picture of the energy consumption looks like around AI. Other issues that AI raise are more related to social agenda. So essentially around, can you trust that AI product? So this relates to, as users of the AI, can you trust the data privacy? Can you trust the algorithm used so it is not leading to discrimination, etc.? Things that comes up as a result of AI being democratized. But as you mentioned, there is no doubt that case for AI investment continues to grow and spans all industry and sectors. At the moment, there is over $200 billion of AI-driven CapEx expected across not just in IT, but also in non-technology sectors. And you've seen the President Trump announcing a $20 billion investment for data centers in the US, in the first phase to come live in areas like Texas, Arizona, etc. So we do see that massive growth and hopefully used for that solution perspective.
So Tomomi, you gave us two examples already on some practical implications on industries like food production, as well as AI when it comes to how environmental issues are leading to social issues. Are there any other areas that you see environmental and social issues are being interlinked?
Sure. I think climate change definitely is where E and S are interlinked. And for example, climate change or global warming can trigger various social issues like job losses due to extreme heat or financial insecurity from declining real estate value caused by wildfires that we have seen recently or rising sea levels. Additionally, global warming contributes to chronic disease, cause of those chronic diseases, and also threatens biodiversity, which is problematic for pharmaceutical companies because biodiversity is very vital for the pharmaceutical innovation, giving a large proportion of pharmaceuticals are still this day deriving from natural compounds found in plants, animals, etc. And again, these are very serious societal structural problems that needs to be addressed and cannot be ignored. And at the same time could be areas of growth, and governments alone would not be able to resolve everything. So that is one of the reasons why some investors, to your earlier question, are looking for companies that can come up with products and services that contributes to resolving these serious issues. Obviously, there is also a need for governments to act still around climate change. There is also a large implementation gap between current global policies and actions which were committed and agreed, which brings us now to global warming at around at least 2.9 degrees Celsius, which is far from what was agreed in Paris Agreement, which was 1.5 degrees above pre-industrial levels. And we have to remember that, well, it might sound like just 1 degrees or 1.4 degrees, but that every 0.1 degrees counts, and the world looks very different with slight difference on the temperature. For example, with 2 degree scenario, we know that 99% of coral reefs are likely to be lost, which is quite scary to think about. So achieving these goals requires a lot of efforts from both private side and public sides, really to mobilize the capital.
So let's drive into the social aspects a little bit more. And I think another more traditional social concerns we've been hearing in really the past 2 decades and beyond is gender gap in wage pay and education. Have we seen an improvement in this area?
Yes, so we have seen some improvements in education in many of the developed markets, but still a lot of work to be done in the emerging market space. And when it comes to wage pay, regrettably, around gender pay gap, many studies indicate that the gender pay gap has widened in the last couple of years. even in developed markets. So in 2022, Korea's gender wage gap was 31.2%. And closing these gaps could drive inclusive economic growth, potentially increasing GDP per capita by 20% by certain studies. So there's definitely a room for improvement.
All right, so we've talked about the environmental impact, social impact, and how that impact on our activities, on our investment. So I think it's quite a good segue into our last topic, the G, governance. Now, this is somewhat interrelated to the gender gap that we discussed just now. The gender diversity of boards, for example, in Hong Kong, the stock exchanges enforced a hard rule to have at least one female representative in the board of directors, and it became effective just at the end of last year. We've also seen Singapore amending its listing rules to require disclosure on board diversity. How are we doing overall in APAC versus other developed economies?
So in the EU, for example, large companies are required to have 40% of non-executive directors from underrepresented represented genders. So in Asia, the percentage of female directors is around 14%, 1/4. So there's room for improvement compared to that level. But board diversity isn't just about gender, and it's really about having the right mix of experience and backgrounds. So if a company who is expanding its supply chain and clientele globally, and yet the board only consists of people with experience of domestic market, that's a red flag. If the company is expanding to digital business, and we might look at if there is a board member who can effectively direct the company from business around digital perspective, as well as managing risks such as cybersecurity risks. Now, overall in Asia, we believe there is room for improvement around board independence, composition, and share ownership concentration. And if companies in Asia improves these aspects and start having more effective boards, that would be a positive catalyst to the share price and the long-term corporate value. We have made it one of our priorities to engage with our underlying companies around board diversity and independence, etc. And we also encourage the companies to disclose these information publicly as much as possible to be recognized by the international investors. And we have also taken some voting action. So we typically vote against election of directors, such as the president of the company, if there is only one or no female directors in certain markets. We have also stated in our voting guidelines that in some markets, the desirable percentage of gender diversity and the timeline, and believe it's important to continue to send those signals.
So I think just to stay on this topic of governance, I think one arguably the most recognized success story is Japan. While the Japan market has done very well in the past year or two, but really the seed was sown back in 2012 in the early phase of the Abenomics. One of the arrows was very much to improve Japanese corporate governance, and over a decade later, I think we are starting to see material shifts in how companies behave. At the same time, we've seen Korea, we've seen China, their authorities, their regulators are also advocating better governance of their companies in order to improve or to protect shareholder value and shareholder rights. So where are we with that? And do we expect results in these areas?
Yes, I agree. Japan is a good example of how corporate governance reform can contribute to market growth. And the cross-shareholding of companies, for example, has dropped by almost 40% in recent years, so just in a matter of 4 to 5 years. And it's also encouraging to see that Korean companies that were flagged for cross-shareholdings, and they are also slowly but also trending down in terms of the percentage of these cross-shareholdings. So we're very glad to see these corporate behaviors around capital allocation changing in the region. As we want to see more companies using their capital to something that contributes to future growth and adds to the value of the company by paying employees competitively or R&D for future growth, or at least paying back to the shareholders instead of holding on to excessive cash or things like cross-shareholdings. Also, from proxy voting perspective, before we cast a vote on AGMs through every year, we conduct deep dive analysis around the distribution of income. So again, Bringing up Japan as an example, we look at the balance between the capital ratio of the company and the total shareholder return, which we believe in general should at least target 30%.
So I think one possible pushback we've been getting from some investors, some of the ESG related strategies performance have been, I would say, a little disappointing. Maybe that's just a macro backdrop, maybe it's a stylistic issue. I'd love to hear your thoughts. So what's driving the performance, but also what are we seeing in terms of demand and flows, not just from APAC investors, but from global investors?
Sure. Many of the ESG or so-called ESG funds, especially that are catered to individual investors today, are focusing on narrower theme with sector biases, to your point. So with the macro backdrop of fossil fuel prices and geopolitical tensions, this did not work in favor from financial return perspective in the last few years, which led to some misconceptions that ESG in general hurts financial performance, which we don't agree. We think we are looking at ESG factors to improve some of the financial returns over the long run. So in this sense, I also would like to remind the listeners that that some of the misconceptions are mainly driven by those sector biases and macroeconomic factors, and also about the timeline. And we always try to remind that the time horizon for some of the sustainable products, financial products, are long term. Switching to the demand side, Europe has been leading the inflows. So last year in Q4, for example, Europe had $18.5 billion, which is actually more than double of the previous quarter last year. In contrast, in the US, we saw some of the deepening outflows. Japan, we also saw some increased redemption from ESG funds. In Asia, ex-Japan, sustainable funds continue to attract new money, with Taiwan and Thailand showing notable inflows driven by local initiatives and investor interest. So looking forward, and in 2025, we do anticipate some changes in the sustainable fund universe due to upcoming EU anti-greenwashing rules related to fund names, with some rebranding of products expected. So there's just one thing to keep in mind. But I think over midterm to long term, the demand for sustainable investments remains strong, with the majority of asset managers and owners expecting increased allocations to sustainable assets over the next 2 years, despite the challenges that we have been hearing and challenges that we have seen around data availability and greenwashing concerns.
So I think just to sum up everything that we've discussed today, first of all, there will be a lot of policy changes and maybe even policy noises coming from various governments in the near term. But I think it's important to recognize that the environmental challenges we're facing is a long-run problem, and therefore requires long-run solutions. And it does call for a bit more patience from investors when looking at performance and return in a longer run. And the second point is, all these are linked to social issues and also governance issues. I mean, I often would argue that I don't think anybody will proactively invest in a poorly run company. So from that angle, again, it's pretty natural that investors should be looking at governance metrics in order to, again, invest in the longer run. Meanwhile, there are plenty of interesting sectors, interesting developments. Tomomi, you mentioned about food production, you mentioned about AI. Some of these will create opportunities, some of the others create challenges. But overall, I think active manager who are embedding ESG process into their investment decisions are likely to come out on top when it comes to facing these challenges. So thank you very much for joining us today, and I look forward to have you back very soon.
Thank you.
Of course, please subscribe and share with your friends and colleagues if you find this podcast useful. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.